Hey everyone, Kachi Vesser back to another video for today. And so as the title said, I'm going to react to Chicken Genius' latest video where he basically said, I dare you to buy this rally. Now, if you enjoy this type of videos where I do reactions, let's say share my thoughts on things that I agree and disagree with, do let me know down in the comments below. If you have other FinTubers that you want me to react to what they're saying, do let me know as well. Now, of course, in this video, I will agree and disagree with some of the things that Chicken Genius has said. I'm also going to reinforce some of the points as well. So stay tuned for that. If you enjoy this type of videos, give it a thumbs up, subscribe if you have not, would really help out the channel. So let's dive right into this.
This rally is not sustainable. I've been busy having fun, nice hotels, fresh powder stove, but I think this video is needed.
Okay, so first of all, I agree. The rally that we're having since the start of the year has been insane. Now, with regards to the two companies that he mentioned, Tesla and Palantir. Tesla right now is up 85% since the close on Friday. But, and this is on a weekly chart, of course, on a daily chart, the RSI is currently oversold. We're going to talk about that in a second. But on the weekly chart, it's still quite okay. Actually, the MACD only turned positive right now. So, do we say that it cannot go higher? Also, if you look at this here, right here, the 200-day moving average, we're not even close there. We haven't even tested it out. So, some might say we might still see a week or two of bullishness and test that 200-day moving average, because as you will see with Palantir, the story here is a bit different. We have tested out the 200-day moving average, got rejected quite fast actually. It was $9.2. We're now at $8.4. So a big rejection here on the 200-day moving average. When it comes to Palantir, the MACD has been bullish for a while. Again, on a weekly chart, RSI still quite okay here. So there is two different stories here to Tesla and Palantir, but both right now on a weekly basis, if you look at technical analysis, it is not oversold, actually not even close. On a daily, of course, you could argue that we're due to a pullback. I 100% agree there.
These are times where the market rally, and if you are in cash, feel stupid. Same are times where the market drops and you are in stocks. It sucks. The market gives you an emotional journey like your most toxic ex-girlfriend, ex-boyfriend, or your current one. Remove emotions from it. Always take a step back and see the big picture. Interest rates are at 5%.
Okay, so before he goes and talks about the interest rates, he mentions something very, very important here, and that's about emotions, sentiment. Like we've seen in the past couple of months with price targets, with analyst expectations. What happens? Well, price drives sentiment. Of course, the stock market plays on your emotions every single day. And it's very true. It's very true. You should not fight that narrative. 1 year ago, a lot of people were fighting that narrative. And what happened? Well, stocks were down 50, 60, 70, 80%. You lost your pants. Then, more recently, in the last couple of months, what happens? Well, certain companies, well, since the start of the year, of course, the overall market. But if you look at October, since then, certain big companies have already bottomed out, let's say. And suddenly, sentiment has changed around those companies. Which one? I'll give two big examples here. Netflix, which has bottomed out a bit before, but Netflix and Meta. Both of them had super negative sentiment attached to it. Of course, the stock was down 60, 70% or so, but the narrative was, well, this company is not going to grow anymore. There is no comeback story here. It's basically dead. Well, guess what? Both companies are up approximately 100% or even more than that since that bottom. And what appeared during the last earnings report? Well, actually, the company is far from dying and it's actually doing okay in the current market environment. So again, big strong point here on emotions, sentiment can change very, very fast on the downside and on the upside as well.
It doesn't impact the economy right away. There is a monetary lag. And you notice most companies are reporting shit earnings this year. Apple just did that shit. Year-over-year numbers are down and yet stock goes higher. Nothing makes sense now. And these are the times where we see signs of a topping process, not.
Okay. Now, with regards to Apple specifically, of course, we've covered Amazon, Google, Meta, other big companies on this channel, but with Apple specifically, the reason why the stock is up after reporting a miss, a first miss in 7 years. First of all, you can see this with a lot of companies out there. Either the stock is up when the earnings report is out, but then it goes down because of the earnings call. Because usually during the earnings call, those are the most important words that come out of management's mouth. What happens with Apple? Well, the outlook, the words that they were given in the earnings call were a bit more bullish than the numbers that were given during the earnings report, such as Tim Cook said Apple would have grown in the vast majority of the markets it operates on a year-over-year basis if not for the significant 800 basis point foreign exchange headwind. Now, the market took this, of course, as a big positive, not only this, but the other aspects that were mentioned there as well, the strong consumer base that it has. And with regards to FX headwinds, in my opinion, and as you can see clearly, euros to dollars, the dollar is weakening, the euro is strengthening. So for companies that had this as a headwind in the latter part of last year, in 2023, this can turn into a tailwind despite earnings growth year over year being a big down. This can help, let's say, softening the blow.
Bottoming process. My core models are near top levels. Trash stocks are rarely identical to last year's August. The bulls are taking a victory laps and the bears are being openly ridiculed. Human nature never changes. I will sit this market out until I see a shift in monetary policy, like a bottoming process in PMIs, inflation nearing 2%, the yield curve back to normal range, blah, blah, blah. This will be a decade of hard money. And until the money printer taps open again, do not fight the big boys. It never ends well.
Okay, so let me just reverse back to this graph right here. Let me see if I can find it. This one. Okay, so first of all, I agree again with what he's saying. Do not fight the big boys. Those were fighting the big boys in 2022, well, obviously lost their pants. Right now, those that are short have been losing their pants for the last couple of months. And it's true that back in August, we had a, well, sort of fake bull rally where a lot of stocks were going up, tried to go over that 200-day moving average, failed, went back down. So that cat bounced. Now, is this the same today? Well, if we're looking at this graph right here, we can clearly see that we might be going even lower. Actually, I have way more information than that. So first of all, I'd like to again mention that when it comes to the job market in the United States, we're still in a very, very good place. For those that missed it, non-farm payrolls came in at over 517,000 versus the only 188,000 expected. Unemployment rate is actually down to 3.4% to the 3.6% expected and the previous 3.5%. So overall, the job market is still very strong. Of course, if you look at it from a narrative of, well, the Fed might look at this and then continue to raise rates aggressively, of course, there is this narrative. But on the other hand, if you listen to what Jerome Powell has said during this week, of course, we had that 25 basis points rate hike and maybe we might see another one. But if you really listen to what he has to say, suddenly you might think, well, maybe there is a pause incoming. And if there is not a pause incoming next, then we might see another 25 basis points. But after that, they might be looking to pause because suddenly he did say, well, the first sign of deflation is now becoming more visible. Of course, we still have the CPI report that has to come out that will probably make or break, let's say, the expectations. Because if we continue to see this downtrend, obviously the Fed is looking at those numbers as well. Now, I'm not done with showing you some nice graphs here. Continuing on what Chicken Genius has said, now you can see the PMI, Purchasing Managers Index cycle, is now clearly into the contraction quadrant, which suggests that earnings estimate revision will continue to be down. Now, based on the inverted yield curve, the PMI could decline to the low 40s, taking earnings estimate down with it. Now, of course, you can make the case for bears and bulls, but let's take the bulls in this case since 2023 has started as a bullish year. Now, you could say, fine, we have been down 30%. Well, the PE has seen a drawdown of 30% in 2022. So bulls could make the case here. Indeed, the chart shows that valuations are often rebounding while earnings are contracting. We saw this in 2020, well, it was very, very short there, and in 2009. But of course, the difference between then and now is that now rates have gone from basically 0 to 5 in record time. So you can't really compare both of them, but you can make a point for both sides here, which basically means there is still a big disconnect here as well. In this case, being too bearish too soon, as you can see on the graph right here. Now, again, based on the PMI, a bottom could still be years away. At right now 6.44%, it shows that the Fed is already much tighter than what it implied by the Fed funds target rate, which I believe is the yellow line here. Perhaps this is why the forward curve, the black line, shows such a large pivot into 2024. And now last thing, of course, again going back to a more bearish side, is that when earnings growth comes to 0%, usually it goes down much faster after that as well, as you can see on the graph. Now going back to what Chicken says at the end of this video when he says he's sitting this one out until, well, the money printer starts to print again. Of course, that's not going to happen anytime soon. But in my opinion, being too bearish right now is probably not the best thing. I mean, for those that have not been nimbling for the last couple of months, I don't really see when you would like to buy. I understand that right now with rates being so high, with still some economic uncertainties in Europe, in Asia as well, I understand you want to sit back. But if you actually look at specific companies that you would like to have in your portfolio, I mean, the opportunities of a lifetime were there. If you're asking me, Tesla at $101, $110, great buys. Meta under $90, great buys. Amazon under 80 or at 80, I can't remember if it's Amazon or Google that reached those points, great buys as well. And probably lots of other companies have hit a great point to buy for the long term. Of course, in the short term, we are due to a little pullback because we have been going up day after day, week after week since the start of the year. And the main reason is probably that things aren't as bad as expected. Also, a lot of expectations going into 2023 was that China would not reopen as soon as it did. So what happened now? China has reopened way quicker than expected. This should boost the global economy, not hurt the global economy. Of course, a little balloon in the sky over the United States might change the events that might happen in the coming months. But overall, I don't agree that being too bearish right now is a good thing. I think people will start and are probably starting to be a bit more bullish on the long-term future when they look at specific companies and especially at attractive valuations. So to conclude, despite expecting earnings growth to slow down, despite expecting a little pullback from the market, to me it makes no sense for me to be now extremely bearish on this market. I mean, the time to be extremely bearish was a long time ago. In recent months, as you could have seen, and as I explained in this video, it was time to be a bit more bullish, and the signs show that those that were turning a bit more bullish recently were correct. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.